As the financial markets are currently closed, the regular trading session for Lucid Group Inc. concluded on June 18, 2026 at 4 p.m. Eastern Time, with the stock price sitting at exactly $5.36 per share, marking a solid intraday gain of 4.28% on a trading volume of over 15.8 million shares. While a casual look at the day's green chart might suggest a brief moment of celebration for retail investors tracking their mobile notifications, looking deeper reveals a stark disconnect that most market participants completely miss. The immediate insight that upends current market expectations is not the minor 22-cent daily lift, but the looming legal and operational dark cloud stemming from a multi-week hidden delivery halt that completely derailed the company's first quarter performance. While casual onlookers see a cheap stock trying to form a bottom near its 52-week lows, institutional players are focusing heavily on the structural damage caused by an unauthorized supplier part substitution that froze shipments of the critical Gravity SUV for 29 straight days. This operational misstep quietly carved a massive hole out of expected vehicle deliveries and left a trail of class action lawsuits trailing all the way into July of this year. The general expectation surrounding this electric vehicle maker has always been that its elite engineering and multi-billion-dollar sovereign backing make it an absolute survivor in a brutal automotive landscape. Investors often look at the sleek design of the Air sedan and the promises of the new Gravity SUV and assume that the company will inevitably steal market share from established automotive giants. This narrative is frequently discussed across various online investing communities, where people looking for investment help debate which premium automotive tech will win the long race. But the reality is far more punishing than this optimistic story suggests. The underlying data indicates that engineering excellence means very little when a company suffers from systemic manufacturing vulnerabilities and a burn rate that threatens to dilute existing shareholders to a significant degree. When you check your individual brokerage account or monitor asset movements via the Fidelity mobile app, it becomes very clear that the gap between corporate promises and actual delivery numbers has rarely been wider than it is right now. To truly understand where this equity is moving, we have to look closely at the explosive volatility that characterized the spring trading sessions. Back in late February of this year, general sentiment was moving toward a minor recovery as management pointed toward expanding production capacity and structural efficiency gains. Investors trading on popular investing sites were treating the company as a premium alternative to a volatile Tesla stock or a slow-moving legacy manufacturer. However, the unexpected disclosure in April regarding the month-long vehicle freeze caused an abrupt collapse in the equity's value. Shares plummeted from a comfortable trading zone near $9.96 all the way down into the $8 range over a couple of highly distressed sessions, ultimately wiping out millions in equity valuation. This intense selling pressure was driven by institutional desks rebalancing their portfolios and cutting risk, which triggered heavy technical damage that the asset is still trying to repair today. When an unexpected production halt creates a $150 million revenue shortfall in a single quarter, the market punishes the stock severely, regardless of how much capital is sitting in the bank. This specific revenue miss is where the numbers get incredibly problematic for anyone engaged in self-investing. Wall Street analysts were firmly modeling first quarter revenue to land around $433.8 million, but the actual figures dropped like a stone, coming in between a meager $280 million and $284 million. Paired with that revenue drop was a quarterly operating loss hovering near an astronomical $1 billion, creating an urgent need for management to execute a massive $1.05 billion capital raise that directly diluted current owners. If you are managing your capital through online investment platforms like a premium interactive broker's account or using an automated robo-advisor like the Schwab Intelligent Portfolio System, these sudden dilutive events are exactly what compress your long-term returns. The constant necessity to raise fresh funds by issuing hundreds of millions of new shares acts as a heavy anchor on the stock price, making it incredibly difficult for the equity to sustain any meaningful upside momentum, even when the broader markets are rallying. Let's break down what this business actually does and how its operational model is constructed to see if the current valuation makes sense. The firm operates as a vertically integrated luxury electric vehicle manufacturer, managing everything from internal electric motor development to its own retail networks. Its core product line started with premium luxury sedans designed to beat the range metrics of an elite Tesla stock or a high-end European import, and has since expanded into the premium sports utility vehicle segment. They place a massive corporate emphasis on their proprietary powertrain technology, arguing that their superior battery efficiency gives them a massive competitive
competitive edge over other manufacturers. This technology focus attracts a lot of attention from individuals setting up a Fidelity brokerage or Interactive Brokers stock trading account, as investors look for the next technological leader capable of replicating the historic rise of an Nvidia stock or an Apple stock. The company has concentrated its manufacturing footprint in Arizona while simultaneously building out an assembly presence in Saudi Arabia, given that the country's public investment fund holds a dominant majority stake in the enterprise. However, having an incredibly wealthy backing entity does not automatically solve the complex equations of global automotive logistics. The supply chain crisis that triggered the 29-day shipment freeze on the Gravity SUV involved something as seemingly simple as second-row seat components. An unauthorized supplier chain compromised safety compliance, forcing a complete halt in deliveries during a period when management was actively assuring the public that previous operational bottlenecks had been completely resolved. This exact contradiction between executive rhetoric and factory floor reality is what gave birth to the wave of securities fraud lawsuits that are currently building toward a key legal deadline on July 28, 2026. For a retail investor trying to build wealth through a basic individual brokerage or looking through available Fidelity mutual funds and Fidelity ETFs for stable exposure, this level of corporate opacity introduces a layer of risk that is incredibly difficult to quantify accurately. When analyzing the trading volume and market depth across various modern execution spaces like the Robinhood app or a specialized SoFi investing interface, it is obvious that retail interest remains remarkably high despite the continuous losses. The stock frequently pops up on lists of the most active assets because its low single-digit share price makes it highly accessible for purchasing Robinhood fractional shares. Many retail market participants like using Robinhood stock trading or SoFi active investing to speculate on quick double-digit percentage bounces, hoping for a sudden short squeeze or an outright buyout rumor from the Middle East. But trading a highly distressed asset purely on social media momentum rather than rigorous cash flow analysis can lead to catastrophic portfolio drawdowns. Professional trading desks using an interactive brokerage platform look at the massive short interest and the high cost of borrowing shares, using that data to hedge their positions, while retail traders often get caught holding the bag when new share offerings drop. Comment below how many shares of this stock you currently hold in your portfolio, and whether you believe the primary state-backed investor will eventually buy out the remaining public float to take the company entirely private. Looking directly at the future outlook, the path forward for this luxury brand depends on an incredibly delicate balance of catalysts and systemic risks. On one hand, there are faint signs of a potential structural turnaround that are beginning to catch the eye of contrarian analysts. The company recently initiated a widespread over-the-air software update for its new SUV line, introducing automated driver assistance systems and deep mapping integrations to improve usability for drivers across North America. More importantly, they have secured an expansive autonomous vehicle fleet partnership with major ride-sharing and tech networks, including an arrangement to supply at least 20,000 premium vehicles for fleet deployment over the coming 6 years. If this fleet delivery program scales without further manufacturing defects, it could provide a highly predictable, high-volume revenue stream that could finally stabilize the firm's volatile balance sheet and help reduce its massive quarterly cash burn. On the other hand, the execution risks remain incredibly steep and cannot be ignored by anyone focused on serious online investing. The company is still losing an immense amount of capital on every single vehicle it rolls off the assembly line, and the broader macroeconomic environment features high interest rates that continue to suppress consumer demand for luxury vehicles costing close to 6 figures. Investors reviewing their long-term financial plans via Fidelity Investments or a SoFi robo-advisor must ask themselves whether a car company can truly survive when its quarterly operating losses are nearly 3 times its total quarterly revenue. The persistent threat of further dilution means that even if the business doubles its vehicle output, the value of each individual share could remain completely stagnant if the total outstanding share count continues to climb. When we synthesize this entire landscape, the central conflict for this luxury vehicle brand always comes back to the tense battle between narrative expectation and operational reality. The narrative expectation is a beautiful, high-tech machine backed by infinite wealth, destined to eventually sit alongside an elite Tesla stock or an institutional favorite like an Nvidia stock in the portfolios of the wealthy. The cold reality is a business struggling with basic quality control, facing intense legal scrutiny from aggressive investor rights law firms, and burning through over $1 billion a quarter just to keep the lights on in its production facilities. This massive gap between what investors want to believe and what the financial statements actually show is exactly why the stock has suffered a brutal decline over the past year, leaving many self-investing investors with substantial realized losses. For anyone managing their own investments through a Fidelity trading platform, a Robinhood investment setup, or a premium interactive brokers account, navigating an asset like this requires an absolute commitment to data over emotion. It is easy to get swept up in the excitement of a 4% daily gain or a flashy press release about a new software update, but long-term capital preservation relies entirely on a company's ability to build products efficiently, sell them at a viable profit, and treat its minority shareholders with absolute transparency. Until the production numbers match the executive promises and the structural cash burn is brought under control, this premium electric vehicle maker will remain a highly speculative battlefield where the expectations of hopeful retail investors will continue to clash directly with the harsh reality of corporate execution. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bag, chart. Don't forget to like, comment, and share this video to support the channel.